Basic formulas: debt to capital ratio equals to total debt divided by total capital into 100. Total capital equals to debt plus equity. Fixed interest coverage ratio equals to EBIT divided by interest plus PD. Effective tax rate equals to income tax expense divided by PBT. Dividend rate equals to DPS divided by face value into 100. Dividend yield equals to DPS divided by MPS into 100. Dividend payout ratio equals to DPS divided by EPS into 100. Ratio analysis. Income statement. Sales minus cost of goods sold gives gross profit or gross income or gross margin less operating expenses, that is office and administration overhead and selling and distribution overhead, gives EBIT or PBIT or operating profit or operating income or operating margin minus interest expense, gives EBT or PBT or taxable income minus tax, gives EAT or PAT or net profit or net income or net margin minus preferential dividend, gives earnings available to equity shareholders minus dividend distributed to equity shareholders, gives retained earnings or undistributed profits. Consider a balance sheet. Equity and liabilities, assets. Equity and liability. Share capital. Equity share capital only is considered nowadays. Preference share capitals are less issued in India. Reserves and surplus. Debtor borrowings. Debtor borrowings examples is debentures, bonds, loans. Next, current liabilities. Assets. Fixed assets, current assets, preliminary expenses. Preliminary expenses are not shown nowadays. Total assets equals to fixed assets plus current assets. Total liabilities equals to debt plus current liabilities. Working capital equals to current assets minus current liabilities. Net worth or book value or shareholder funds or equity or net assets equals to share capital plus reserves and surplus minus preliminary expenses. Or total assets minus total liabilities gives net worth or book value or shareholder funds or equity or net assets. Capital employed or invested capital equals to share capital plus reserves and surplus plus debt minus preliminary expenses, or fixed assets plus current assets minus current liabilities. Gross profit ratio. Gross profit divided by sales into 100. Cost of goods sold ratio. Cost of goods sold divided by sales into 100, or 100% minus gross profit ratio. Operating expense ratio, that equals to operating expense divided by sales into 100. Operating profit ratio, that equals to EBIT divided by sales into 100. Operating ratio, cost of goods sold plus operating expenses divided by sales into 100, or 100% minus operating profit ratio. Net profit ratio, net profit divided by sales into 100. Debt ratio or debt to capital employed ratio equals to debt divided by debt plus equity into 100, or 1 minus equity ratio. Equity ratio or equity to capital employed ratio equals to equity divided by debt plus equity into 100, or 1 minus debt ratio. Debt to equity ratio equals to debt by equity. Assets turnover ratio, that equals to turnover or sales divided by assets into 100. Fixed assets turnover ratio, that equals to sales divided by fixed assets into 100. Current assets turnover ratio, that equals to sales divided by current assets into 100. Inventory turnover ratio, that equals to cost of goods sold divided by stock into 100. Debtors turnover ratio, that equals to credit sales divided by debtors into 100. Assets to sales ratio, that equals to assets divided by sales into 100. Interest coverage ratio, that equals to EBIT divided by interest into 100. Higher interest coverage ratio is better. Fixed interest and fixed dividend coverage ratio equals to PAT, profit after tax plus interest divided by interest plus preferential dividend into 100. Higher fixed interest and fixed dividend coverage ratio is better. Capital gearing ratio equals to debt plus preferential capital divided by equity share capital plus reserves and surplus into 100. Lower capital gearing ratio is better. Dividend payout ratio, that equals to dividend distributed to equity shareholders divided by earnings available to equity shareholders into 100 or 1 minus retention ratio. Retention ratio equals to retained earnings divided by earnings available to equity shareholders into 100 or 100% minus dividend payout ratio gives retention ratio. Dividend yield, dividend distributed to equity shareholders divided by market price of equity shares into 100. EPS, earnings available to equity shareholders divided by number of equity shares. DPS, dividend distributed to equity shareholders divided by number of equity shares. Book value per share, book value or net worth divided by number of equity shares. Return on capital employed or return on investment equals to EBIT divided by capital employed into 100. Return on equity equals to earnings available to equity shareholders divided by net worth into 100 or EPS divided by book value per share into 100 or EPS by MPS into 100. Price earning ratio, MPS divided by EPS into 100 or 1 by return on equity gives price earning ratio. Market capitalization, it means the total market value of equity shareholders that equals to MPS into number of equity shares. Another way to calculate market capitalization is price earning ratio into earnings available to equity shareholders. Number of shares issued by the company equals to number of shares held by promoters, that is promoters holding, plus number of shares held by minority or outside shareholders, that is minority holding or non-controlling interest holdings. Promoters holding in a company in percentage is number of shares held by the promoter of the company divided by total number of shares issued by the company into 100. Minority holding or non-controlling interest holding in a company percentage equals to number of shares held by minority shareholders or non-controlling interest holders divided by total number of shares issued by the company into 100. Free float market capitalization, it means market value of outsider or minority equity shareholders of a company or non-controlling interest holders of a company. Free float market capitalization equals to MPS into number of equity shares held by outsiders or minority shareholders or non-controlling interest holders. Next, 1 million equals to 10 lakhs, 1 billion 100 crores, 1 trillion 1 lakh crores. 100 basis points means 1%. Dividend is calculated on face value. Dividend yield is calculated on market price. Dividend payout is calculated on earnings. Required or expected rate of return of investors on securities as per CAPM equals to RF plus beta into RM minus RF. RF, risk-free rate of return. Example, T-bills, government securities, liquid bonds, etc. RM, market rate of return. Example, Sensex, Nifty, Index, etc. Beta of security. RM minus RF means risk premium in the market. Beta into RM minus RF means beta into RM minus RF equals to risk premium on security. RM minus RF, risk premium in market. Beta into RM minus RF, risk premium on security.